Welcome to the FarmLink 5-part series on the elements of charting, with your host, Harold Davis. Part 2, Exhaustion, Tops, Bottoms, and Reversals.
The elements of charting. Part 2 is about exhaustion, tops, bottoms, and reversal patterns. As we said at the end of Part 1, a large trend was subject to a break that forced this market into neutral. Looking for direction, a new consensus has to be built before the next trend can emerge. So just a reminder, a trend break does not necessarily put you into a trend in the opposite direction. It means that the market has a new direction to search for and a new decision to make. While we're waiting for the new trend to emerge, the market will often rally back towards the previous major trend line using what's called a return move. A return move is an attempt by participants to regain former momentum and test the old trend direction. Usually, return moves do not succeed right away, and there will be additional correction and settling back to do before the market builds a new consensus. It's also worth noting that when a bear market trend is broken, in which case it would be broken by a rally, there can be a price down move towards the old downtrend line that is also return move before it goes into its consolidation and correction phase. So in this case, the return move was followed by a new uptrend. However, this is not always the case. Here we have a trend break. You can see the very visible return move up underneath the old uptrend line, but the market is starting to falter again. Indeed, the market is down testing something called horizontal support. And this return move, when it falters and the price is moving from neutral, could take it into a bear market. A violation of underlying support would be an important clue as to its future direction, and as a general rule, an examination of the context helps interpret any move. So when we look at the trend break and the return move, we also look at things like support zones and the length of time that the market was in a bull move to help us determine whether or not there could be a greater damage done. This price action could also be interpreted as a head and shoulders top formation. If so, the downside target could be as much as twice the distance from the top to the neckline. This is far below current levels and worth knowing in advance. Remember, we said that charting could help with your marketing discipline and risk management. Suppose that the old tops on this chart were around $15 and the price levels on the return move were at, say, $14 a bushel. But prices have been fading and they're now down to $12. Now, from the standpoint of managing your inventory and what you have in the bin, do you want to hold out for a return bounce back up to $13 or $14 again? Or do you want to move promptly to avoid having the prospect of receiving only $9 a bushel? That's why charting can help you avoid timely mistakes and hoping for the best instead of cold, hard business logic. Head and shoulders formations don't always measure from the head down to the neckline. Certainly that's the starting measurement that we're going to use here, but you'll notice that on this example of a head and shoulders top, possibly because of its short-term duration and violence, the equivalent measure was not from the neckline down, but from the shoulder down. And again, it pointed out a distressingly low price and was a good thing to know about well in advance. Well, when we look at the variety of tops, we've already looked at the head and shoulder formation. A different type of top, closely akin to the head and shoulders, is a triple top. The distinction with a triple top is that there is no clear neckline. Prices just churn like the water at the top of a fountain before eventually falling back to earth. A double top is a much simpler affair. It has the shape of a large M, and the downside objective of a double top is twice the height of the M. Everybody's heard about church steeple tops, but they're usually referred to as spike tops by chartists. and they live up to the old adage that the higher they rise, the harder they fall. After the collapse, there appears to have been some truth behind the optimism because it generated high values again later. So what we have here is an old bull market that got carried away, went into euphoria, everybody was jumping on board the good news. Eventually, profit-taking took over, and possibly because and there were also new sellers who thought that those lofty levels were unjustified, and between the two groups, prices were beaten up and they collapsed in a hurry. The part of the reason for the speed of the collapse is because a lot of people were trying to squeeze through a very narrow door in a hurry. However, as we said at the beginning, all these price moves have their basis in supply and demand. So the supply and demand arguments that generated the original uptrend are still valid, still intact, and that's why prices recovered back up to a high level even after this panic and retreat. Triple tops expand in nature, and they're a long, drawn-out process. The repeated wide-swinging gyrations exhaust the bulls and the bears alike, and the eventual sell-off is often not much more than the losses already experienced. Triple tops are tough to identify, and the clues are expanding volatility and horizontal or declining lows. Wide-swinging gyrations of any sort after an extended move can be the sign that control of the market is passing from strong hands, which are generally defined as early, knowledgeable buyers and far-sighted players, to weak hands. Those are the latecomers jumping on board. Chartists call this process of moving from strong hands to weak distribution, and it's the hallmark of a top that will remain unchallenged for quite some time. Well, we've looked at a lot of tops. Some of the same formations actually work as bottoms. Here we have a head and shoulders bottom. And again, we measured from the top of the head to the neckline and projected that up, and it gave us a target objective. Of course, this market moved far beyond that because this was the beginning of a major trend. But still, it was a worthwhile calculation to make because it warned us, or should I say gave us advance warning, of a price improvement that maybe was something that we were waiting for. Like the tops, double bottoms can be perfect W's or slightly asymmetrical, which is to say the second bottom will be a little higher than the first bottom or a little lower. Note how prices jumped when they rose above the top of the W. So they began to accelerate as they were breaking free. The double height target turned out to be conservative in this case, and we can see this again as a bottom that was the birth of a major trend. A rounding bottom is often a slow affair. However, there's a reason why old traders say never sell a dull market. Quietly rounding bottoms are often the proverbial calm before the storm. Rounding bottom is consistent with a progressive transition from bearish to bullish. Now, I should point out that this particular rounding bottom was more than 2 years in the making. This is a monthly chart of this particular commodity. And the gradual turn reflected weighty fundamentals that took a while to dissipate, like large carryover stocks. As the old factors diminish, new drivers become increasingly important and eventually take over. We see in this case it was followed by a very nice up move. Now, V bottoms, like the fast V tops or spike tops, they quickly correct unwarranted weakness. The previous downtrend had already punished prices severely, but sometimes a market does not know when enough is enough until it has gone too far. As we said, what's new to you may already be old hat to the market. Imagine a lot of the original sellers in this that pushed prices down in the V bottom thought that they were responding to timely information and to timely forecasts and perceptions about the market. But it turns out that other people were waiting to take advantage of them, and prices recovered very rapidly. That's why being too late or too early can be very expensive. Other types of reversals are called traps. A bull trap is a small rally that looks like a breakout from a formation. Now, they You see this overhead resistance and the prices rise above that and you think, oh good, here we go again. After a zone of consolidation, we're ready to move. But in this case, prices have absolutely no follow-through. By failing to gain friends, it's an indication that the real weight of opinion is on the other side of the market and a reversal is about to unfold. The ensuing downdraft can be vicious. So, when a market tries to break out and tries to improve and it fails, watch out, because it's going to go the other way. Well, the opposite of a bull trap is a bear trap. And a bear trap is a small dip that looks like a breakdown from a formation, but it also has absolutely no follow-through. It's like a head fake in the wrong direction. It indicates that the consensus is on the other side of the market, a reversal is about to unfold, and the ensuing rally could be major.
Thanks for watching, and please check out the next part in the series, Support and Resistance, Trading Ranges, and Corrections.